So yes, I guess we put out the bulletin last week about inflation trepidation, and the market starts falling off yesterday and today. But actually, the trepidation I was talking about last week was more to do with the dilemma that the Bank of England has on inflation rates and the bond market. But this week, it's been the equity market that's taken a bit of a hit. But everybody's panicking about what's happening between Korea and the US. But for as long as I can remember, there's always been something around in the world to rattle you. If my Sunday school days serve me well, I think somewhere in Matthew it says there'll be wars and rumours of wars, be not troubled. Now actually, when you're managing people's money, you have to take a very remote view of everything. And ironically, and strange as it may seem to people, it's not the wars that destroy equity value, it's generally leverage, i.e. when people have got too much borrowing, not enough asset, and they're very exposed to even a minor move in the marketplace. And right now, the UK banks are nowhere near leverage as much as they were 10 years ago. So the risk in that regard has dropped. What we've been trying to achieve over the last 12 months is be a little careful, because although, as I've said, it's not wars that are the real threat to your asset value or the rumours of them. And just to be clear, I don't mean that callously. I just mean in our job, we've got to take a professional view. We're paid by investors to look after their money. So we have to take a dispassionate view of what's happening in the globe. But the real difficulty for us in the past year has been finding investments that are good value, and in particular ways in which we can de-risk portfolios a little bit. We've had a fantastic run since 2011 with ever upward equity markets, and whilst they're not expensive, they're not as cheap as they were. It's very hard to find bonds that give you anything like a decent yield without taking on too much risk. So, a yield of sort of 1.5% on 10-year government bonds is hardly attractive when inflation has just gone to 2.6%. So actually for us, it's been a really difficult period. But it's not just because of the political problems around the world, it's because of the nature of markets. And when I say difficult, it's been difficult trying to find the right quality of assets that you want for the longer term, and so we've just been a little more cautious than we've been for a while. So am I happy that we're sitting here on a Friday with the market just taking a 1 to 2% wallop and we're a bit more conservative? Yeah, of course I am. But I'm not stupid enough to think that that's going to make the difference to the returns over the next 12 months. I'm not going to be judged on 1 or 2 days. Our team's not going to be assessed on a 48-hour period. It's what we do over the very long term, because our clients' objectives and goals are over the very, very long term. But yes, we've been cautious and the market's wobbled, so I'm pleased. Now, if you're asking me now, are we going to get more cautious? No, because I think that when you look at the strength of underlying companies, earnings have been good, liquidity for business has been good, the world economy is growing again, trade is improving. The flip side of all the geopolitical risk is that actually, the economy is looking a lot better. And that is more likely to be the driver that makes the difference to equity prices than geopolitical risks, which the market will very often take on board and then dismiss. And as an example of that, when the first war with Iraq started and the Iraqis invaded Kuwait, the market went off. Everybody was then pensive about what would happen. The following spring, when the first American bombers dropped their bombs, the market went up. In actual fact, as the war started, the market improved. If you had walked away and sold everything and not come back in until the war was over, you would have lost money. And that, I think, is important when you're thinking about assets. Think longer term, think of the intrinsic value, and try not to let the geopolitical conflicts around the world worry you too much. What I think is interesting for us, and the way I approach things today, is, 2 or 3 years' time, the company's going to be 40 years old. And we've got clients that we've looked after their assets for 30 plus years now, which is an extraordinary track record to have. I don't mean in terms of, it means we've got some longevity in these relationships. And what is interesting is that the clients that have been with us for all that period know these ups and down times will come, and they know the way we respond to them. We stay calm, we don't panic, we look for value, and we will try and be the buyers when nobody else wants to. And probably the last best example of that was going back to the latter part of 2011, when the market went into a complete panic and we took our equity exposure up again in 2015. But we've done it. We've achieved these very, very good returns recently, for which we've had good recognition within the industry. We've achieved these without being too risky, and that's the way we like to do our business. Nobody wants to wake up one day and find that they've been wiped out on their portfolio. That's not what this is all about. That's why I'm always going on and on about being diversified. Don't put all your money into just one share, or even a couple of shares, or one bond, or one property. Be diversified, be sensible, and keep liquid. Because if you've got liquidity, you can pay for anything you need to pay for in the immediate term, and meet any emergencies without having to go and get stuck into your long-term assets, which may have a downturn on price. So it's really doing the basics. And I think the long-term people that have been with us for that 30 odd years, 3 decades, have seen an awful lot of ups and downs in that period, including one of the worst financial crises the world has ever experienced. So you've just got to keep your head. And effectively, I always remind everybody on our team, and we've got a sensible bunch of guys on the investment team, but our clients pay us to keep our heads, not lose them. So what am I going to do with the rest of my day? So it's nearly 10 o'clock. There's quite a lot of interesting pricing on call options. So as soon as I've finished talking to you, I'm going to get back in my office and see if we can pick up some bargains, because I suspect there will be a few around today.